freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast for Freedom Leads and Real Wealth Follows. I'm Dustin Bailey, and here as always, I'm with Adam Penn. Adam, how you doing today?
I'm doing great. I'm enjoying the weather. We're working on a flip house.
Yeah.
We wrote an LOI on a property today.
I wrote an LOI on a property today.
It said my name and it went to my email.
Well, I was the one who drafted most of it, so
that makes you an assistant.
I'm an assistant to the regional manager. Yes.
Yep.
That's what it is here.
Yeah.
No, that is exciting. Yeah, we got an LOI on a property. That's always fun.
I had an LOI accepted the other day on that cherry unit.
Very nice. The one we did the deep dive on.
Yeah.
Yeah. Oh, that's exciting. When's your closing date on that?
Like August. They're waiting. They're basically, I think we're leading out their debt expiring.
Gotcha. Okay. Very nice. Well, that's exciting.
Yeah. Let's talk about why people are here today.
Yeah. No, we have a guest today, which is exciting. Always like bringing guests. So we've got Vessi Kapoulian is joining us today, and she's a real estate investor. Got a really interesting background. We dive into that a little bit. She grew up in Bulgaria, grew up behind the Iron Curtain, so definitely has an interesting perspective on freedom. But she worked in the commercial lending space for a while, and so that gives her a very interesting perspective for looking at deals now, and for sort of how she evaluates things. And she definitely looks at them a little bit differently than I think those of us who've never sort of had that background do. But it's good. But I think that's good, and she's also got some good insights for some passive investors as well. So without further ado, we can dive right straight into that interview. All right, Vessi, welcome to the show. We're so glad to have you on.
Thank you so much for having me on, Adam and Dustin. It's a pleasure to be here today.
Adam, kick us off here.
I can kind of start it off. I mean, obviously, a handful of questions we have for you, and then second to that is kind of just more of a free-flowing conversation, right? This isn't a tech interview coming right out of college where we're going to ask 10,000 questions and you can't ask us questions. I find that some of the episodes that get kind of the most views are the ones that we have a good dialogue back and forth, right? Maybe we have a different opinion or we dive into a topic. And so we do have some pre-built questions, but for the most part, this is just going to be a nice, fun conversation. And maybe to kick it off, if you want, just tell our audience a little bit about your background, what made you interested in investing. A lot of our listeners are in the tech space. So they're going to be high-level engineers, they're going to be project managers, things of that space. So maybe give us a little bit of your background and why you're here today.
Absolutely. No, I'll hit the key points. We can definitely go into more detail in any of those. But I grew up behind the Iron Curtain, so in a very different time, very different place. And I mentioned that because as I reflect back on my journey, I think that's when the seed of real estate investing was planted in me. But it took a while to get there. I always had a dream to come and study in the US. And since paying for college was not really an option, earning a full scholarship was really my only way to make that happen. And so I focused on academics. I made it happen and came to the US. It was amazing to have that dream realized. But then I continued on to what most people call the traditional path, which is completing my undergraduate, later on my graduate degree, getting a corporate job and climbing that corporate ladder. At least that's what success was painted to me as. And I stayed on that track for a number of years until a few events caused me to take a step back and reconsider, am I really on the right track? One was as I looked up that corporate ladder and tried to fast forward a few years of what happens, right? If I get that next title or next manager role, I realized I'm really tapped out in terms of the income that I can make as an employee. And I'm only trading more time, precious time away from family and loved ones for money, not incrementally more money, just a little bit more money. And then apart from that, there were other events, exogenous events like the global financial crisis that left a lot of people with decimated retirement portfolios or without jobs or both. And then over the years, my own employer going through a couple of restructures, and I think we're seeing a lot of that in the news today. And that left me really scared. I was spared during one of those restructures, or at least during the first one that hit near and dear to my heart. But I ask myself, what if I'm next? I mean, these are cost-cutting measures, and I was probably spared not because I'm brighter or smarter than any of my colleagues that were let go. I was probably lower paid, so I I had to take charge of my own destiny, and that's when I think the seed of real estate germinated. And unfortunately, a bit too late. I wish I had started earlier, but it came in at the right time, and I thought, okay, well, maybe I'll just buy one or two retirement, like small single family homes, and that will be my retirement portfolio. And it was scary, but I did it. I'm glad I did it because that first property turned into a second, a third, and fourth one. And I think that's when the light bulb went on as to, wow, this is not just a small retirement nest egg. This can be a whole other income stream that can provide much needed cushion in the event of duress, such as a layoff uh, or the stock market fluctuating. And so as I took a step back and thought through, that's so great, but how do I scale it? And really, there were two options that I saw. One was buy hundreds of single family homes, which I didn't have the capital nor the time to manage by myself.
Well, a lot of time to manage that.
A lot of time. So I figured, well, if I'm going to be leveraging other people's money and their skill set, I might as well do it in a more organized manner. And that's what prompted me to transition to multifamily. So
And you
yeah.
have some background in the commercial lending side of
Yes.
things. So do you want to, did that influence your decisions into doing multifamily?
It definitely did. So first of all, I had the background, I guess, sitting on the other side of the table as a lender in terms of evaluating commercial properties. And I was part of the global banking or global finance team, and I focused on middle market multinationals. But at one point, when I got promoted within the domestic group of the bank that I work for, a huge chunk of our business was real estate, primarily multifamily, industrial, commercial, retail. And I would look at my customers' personal financial statements and think, wow, they're really making a living out of this. This is really a full-time occupation. So that was another aha moment. But to answer your question, having the background really helped because as I transitioned from the single family to the multifamily investing space, it really helped keep me grounded, right? As a lender, you always look at the downside, at the risk. As an investor, you look at the upside and the opportunities. So I did have some learning curve, right, to go through as an investor, but I do appreciate having that lender background to keep me grounded as I evaluate investment opportunities today.
Well, one thing you said there I thought was kind of interesting. So you said that while you were in the lending space, you'd see personal financial statements and you were able to see, wow, these people are really making a business out of that. And that's an interesting perspective because I think a lot of people get into this space from a standpoint of, I see someone with a big flashy check, right? Oh, they exited this building and they made 10x on their money or whatever it was. But you didn't see that, right? You saw like the cold, hard facts of people that were day in and day out operating in this business. And you're like, this isn't one guy flashing a check. This is repetitive underwriting from a bank being like, yes, this is a business. This is how these people make money, and seeing it over and over from all those. And I mean, don't say anything you can't say, but from all those financial statements you saw, what was kind of some common themes that you saw that now you use as kind of this is why I want to invest in this space, or, oh, they did this type of asset and it worked well? Because you probably saw a lot of how people's portfolios were structured.
Absolutely, yes. So there are a few key themes that emerged. One is the people, right? As a lender, a former lender, is to say people pay back loans, not properties. Of course, we take the property as collateral, and that's important, and it's part of the lending decision. But really, the people come first, and really, working with those that have the experience, the background, who have weathered cycles. Now, as an investor, I look at those qualities or features, if you will, in a potential sponsor or operator, and that's managing the deal. Second was cash flow, right? There are different investment theses that people take. Some go for the equity yield. I personally like the cash flow. One, for me personally, that creates that added income stream that I initially needed as a cushion, and now that supports my living. But secondly, for my customers, right, those who had a well diversified portfolio that's well managed and then cash flowing, had ample cushion to weather storms or setbacks that inevitably appear and happen while managing the life cycle of a deal. So and then leverage is number three. I know as investors, we always like to have high leverage because it enhances the returns, but a higher return also, to me, translates to higher probability for loss. And so it's important to recognize that. And those who are really successful were moderately or lowly levered, which, again, during fluctuations of the business cycle, allow them to be more flexible and navigate through those challenges.
I think that's a really interesting point, and we're very cash flow focused, right? I mean, we talk about that all the time. It's that equity appreciation is great, but it can also get wiped out like that, right?
Mm-hmm.
I mean, if you're getting a monthly check, it's unlikely that those rents are just going to dry up overnight. Even COVID took a little while for there to be complete rent stops, and but you can have market value crashes really quickly. One thing that you said there, and then maybe we can change topics, is the loan to value type of the equation, right? And so that the leverage, higher leverage, could equal more risk. And I'm completely in agreement with you there. And something that's interesting that I've seen over the last 4 years is one of our mentors was actually doing in 2021-ish, 2022, was doing cash in refinances. When everyone else was like, hey, everything's amazing, we're pulling all this money out, he was putting money back into his properties and lowering his loan to values at 3%, 4% interest. It's not something you see all that often. So do you have any comments on that, or thoughts about what's a safe loan to value for the types of deals you look at?
Yeah, so it really obviously depends on the market and the type of the property, right? My answer would be one for hotels versus multifamily properties, but let's stick to multifamily. That's the lane I play in today. I would say my personal comfort level would be no more than 70%, right? And that really accounts for that potential doomsday scenario on market fluctuation. And unfortunately, we've experienced that, where we've seen property values, again, depending on market flow, anywhere from 20 to 30%. So it gives you at least a little bit of a cushion if that event was to happen. But ultimately, right, the lender would look at the cash flow of the property. And if it's super, super strong to support not only the minimum 125 times debt service coverage that most lenders require, but with ample cushion above it, then there may be reasons, right, to increase the LTV. And like 75 is probably the highest I've seen it go on the traditional lending side, like banks. Now other providers in the last couple of years, I know bridge lenders, right, that increased to 80, sometimes more. And we're seeing the results of that in today's environment. But if I was to give a number, I would say probably 70 would be my personal comfort level, unless there is a ton of cushion, like excess reserves and super strong cash flow.
Well, and that matches what banks are willing to deal with, right? So, when people are like, oh, we're going to try to get bridge debt, push as high as we can, there's a reason that banks are only willing to go up to 65, 70%. I mean, they're doing the same underwriting we are. They're just being even a little more conservative. Yeah. So you're in a handful of markets. Do you have any criteria that you use for selecting markets? Or let's dive a little bit more into maybe some of the aspects of your transition from single family, which I'm assuming started in the town you lived in, to where else you've purchased properties, and what made those markets either good or bad.
Yeah, so I wish I had invested in my backyard, but I live in Southern California. So considering that my main goal was cash flow, that made it
hard to get down there.
very, very difficult. And I mean, I guess if you buy all cash, but the median home value here is $1 million. So I didn't have that much cash laying around. So that automatically at the time pushed me to invest out of state, which is why it was a scary process, because I felt like, oh gosh, I need the property to be in my backyard so I can control it better. And while there is something to be said about having that boots on the ground presence, either directly or through trusted partners, I learned to develop that trust level again through people that I met here locally who introduced me to investors in that market. And I'm glad I did it, because that opened up a world of opportunities. And now all of my multifamily holdings are out of state. They're not in California. With that said, apart from the regulatory environment in business-friendly locations, I definitely look at fundamentals like population growth, job growth, certain median household income levels and median household income growth. Job diversity is a key one. And then within the neighborhoods or the submarkets, I definitely zero in again on the median household income, the crime rate, the poverty rate. I go deeper into comparing affordability, median home values, and a whole other criteria that I like to dig in just to make sure that the market is solid, because I like to equate it to the tailwinds, right? That help you propel you farther during maybe periods of duress. If you're in a stronger market, that definitely helps soften the blow at least a little bit. But if you're in a tough market and then you get hit with macroeconomic headwinds and or other property challenges, then it's a recipe for disaster.
So, from that kind of looking at all those macroeconomic trends, we have a lot of people that listen to the show that are very interested in real estate. They're probably experts in their field, but they might not be experts in real estate. What are some red flags that instantly go off when you're looking at a deal? What are some things that you look for that you're like, oh, that's not right, when you're analyzing a deal?
Yeah, so considering that my primary goal is cash flow, I look for properties that cash flow on day one. And there are a few ways to gauge that, even before looking at the 2-point font spreadsheet that of the underwriting. So one thing that I look for is positive leverage, which basically means that I want my cap rate, or personally I prefer to look at yield on cost, and I'm happy to define those for the listeners if you think that needed. But I'd like that number, which is the unlevered return on investment, to exceed the cost of debt. So positive leverage is one factor. With cash flow on day one, I do like to see adequate cushion, and one way to measure that is by looking at the break-even occupancy of the property. So having a number that's 70% and even lower is ideal, but I don't like to go, or don't like to exceed 80%, which basically means if 20% of my top line collapses, I can still pay my bills, operating expenses, and debt service. So I look for that cushion. And then so these are two in terms of the profile of the properties. And then these days there's a lot of optimism around where rates will head. I don't know where rates will be a year, 2 or 5 from now, but some colleagues in the space have very strong opinions that those will decrease drastically, and so they model their deals accordingly with declining cap rates. So when I see that in a deal, that's an automatic no for me, because I'm not Nostradamus. I don't know where rates would be. I prefer not to speculate. And so I would like to plan for the worst, hope for the best, which is why when I underwrite, I like to assume cap rate expansion. So those would be just 3 that I mentioned, but I have a 100-point checklist that I go through when I vet deals and sponsors, so I can go deeper if you'd like.
No, that's awesome. I can guarantee that rates will either go up or down in the future.
There you go.
Yeah.
Or stay the same.
They might stay the same. Dustin, did you have any questions you wanted to ask?
Yeah, I actually think that's an interesting lead in to talking about like looking at deals and looking at sponsors, and so like taking sort of that passive view, because I think it's important to know how a sponsor looks at a deal, right, and what their deal criteria are. But then you've also, I feel like as a passive investor, you've almost got to take the same approach. Anytime a sponsor puts a deal in front of you, you've almost got to look at the same sorts of things that maybe they are to see, okay, does this line up with what I'm looking for, like gauging the real risk of the deal. So I'm just kind of curious, like your sort of framework or how you would approach vetting not only just the sponsor in general, right, and their track record and background, things like that, but then being able to vet any sort of deal that a sponsor might put in front of a passive investor.
Yeah, so yes, but definitely when it comes to the sponsor, that's actually where I start. The deal is the easiest to pick apart because it's so quantitative, right? And it's so you can validate their assumptions. And I would always recommend validate the assumptions. Don't take them for granted. But the sponsor is where I start. Definitely would like to understand what their track record is, and not just, hey, we achieved X IRR on these 5 deals over the last 5 years. We know that in recent history, right, cap rate compression made even the worst operator look like a hero, right? But we're not in that environment now. So I always want to understand, okay, it's so great that you achieve these IRRs and pro forma and whatnot, but how does the actual NOI compare to what you projected? And to the extent it didn't deliver, what caused that, right? And I'm not looking for perfection, just to be clear, because anyone who's been in the business long enough has gone through challenges. What I'm really looking to understand, especially when if there were challenges, what did they learn from that? How are they applying that in their current business model? Very similar, and I think it's more relevant now than ever, is the history of capital calls and pause distributions. Again, I'm not looking for perfection here. Obviously, if they say we had none, that checks a lot of boxes. But if they did, again, what I'm looking to understand is how did they overcome the challenge? How did they communicate to investors? Did they surprise them at the 11th hour? Because I consult a lot of passive investors as well. So unfortunately, I see that a lot where they're getting a capital call and it's due within the next 2 weeks. So is this how it was communicated? And then 3, which leads me to the third criteria that I look at apart from the track record, is the level of communication and transparency. How frequent is it? How open? How detailed it is? And as a passive investor, you can always ask for a sample of their reporting. I always like to ask, hey, give me one of your standard reports, and also give me one where perhaps a deal was going through some challenges. I want to see a sample of that communication. And generally speaking, the sponsor will share that with you. If they don't, that's at a minimum a pink flag that's kind of getting raised in my mind. And then as far as the deal itself, I think we talked about the cap rate, that being a driving factor. Another thing I often see is getting skipped over, and I know a lot of it is intentional, is reserves. It's not a matter of if, it's a matter of when you go through a setback or a challenge. At the end of the day, these are 5-year life cycles, so a lot can and actually does happen during these 5 years. So I view the operating reserves as my rainy day fund. And oftentimes sponsors would set a very minimal amount, like 1 or 2 months, which is definitely not enough. And sometimes not even at all. They're looking to build those reserves out of cash flow. And that to me is a very risky proposition, right? Of course, absent these reserves, the returns are higher. But again, high return to me equals higher probability for loss. So it's important for investors to understand, if they're comfortable with that risk, at least understand it, acknowledge it, and be aware that they may be knocking on your door for a capital call, right? If something was to happen. And if you're comfortable with that, then get in the deal with that type of return profile. So cap rates, adequate reserves, and like I said, validating the assumptions on rents, expenses, just making sure those are in line with the market, which is why, again, after the sponsor, right, the market is the second thing I look at and the deal is the last. And if it's a market that's historically supported, for example, 2% rent growth, and now all of a sudden you're showing me, oh, we're going to increase rents by 3 to 4% year over year. Again, that raises red flags. And Sadly, I've seen that. Just a month ago, I saw that on a deal. So these things do happen, and it's important to peel the onion to its core to then take a step back as a passive investor and ask the question, am I comfortable with this? And as long as that's within your risk tolerance and your understanding, then that's great. But it's important to have that understanding upfront.
That's really, really good. We talk about that often, right? Is like there's deals and deal profiles, like it's not necessarily good or bad. We have our preference, but you need to understand like your risk tolerance, your preferences, and as an investor, does the deal you're about to invest in actually align with that? Because even if it's an otherwise good deal, but it doesn't align with what you want or need, then it's not really serving the purpose for you. And I also think the operating reserves is something everybody overlooks. I don't know the last time. I don't know if we've ever had a passive investor ask about something like that. And I guess that's really a good thing coming from I'm just sitting here thinking the only people that tend to ask about that are the banks. So the lenders definitely
Yes.
care about those things. But no, it's important, right? Because if you run out, then that's exactly when the capital call happens, or the sponsor starts stacking on some kind of debt that's maybe disclosed, maybe not, and that starts getting into some odd spaces. So I think it's really, really good. I want to be mindful of time here. Adam, you have any other questions?
If you've got some, you can go ahead.
I just want to ask, we always ask I guess we're calling it now the freedom question. But Vessi, just given your background and kind of where you grew up, I would imagine that I'm excited to hear your answer. I mentioned that before we hit record. So, we always ask the question, what does freedom, what does independence, what does that mean to you, and kind of how do you manifest that in your everyday life?
Yes, absolutely. So when I was a little girl, right, dreaming back in Bulgaria, it really came to what freedom meant to me at that time was more opportunities, right, to earn and accomplish what you can with your hard work, your capabilities, taking action, right, and not just being put into a bucket or a certain box and being told, here's what you'll do, here's who you need to be. But now having gone through the journey that I described, to me, freedom translates to more optionality, right? Freedom to be with whoever you want, wherever you want, interact with people, obviously in a respectful manner, however you want. And for me, the vehicle towards achieving that freedom has been real estate. That, of course, is not the only vehicle. There are others out there, but that's what's enabled that journey for me. And when one beautiful day I faced my own corporate restructure, right, and then I was the one who was impacted and let go, it was thanks to real estate that I had options to consider, right? I wasn't automatically pushed down the path of polish your resume and go find another job so you can grind grind some more and not have the certainty that this won't happen again. Thankfully, I was in a place where I could choose, and I chose to go down the path of entrepreneurship. But I would not have been there if I hadn't taken that calculated risk and thoughtful, consistent action to build a cash flow and portfolio that created that optionality for me.
So I think the only last question I have, and then maybe we can wrap this up, is just for the person sitting there grinding away 60 hours a week, whatever it may be, could be a high income, right? In Bay Area, you could be $300,000, $400,000, $500,000 a year. What are some of the first steps that you would take if you were sitting back in that, knowing kind of what you know now and obviously all your experience? What's the first step to start to get there?
I would say the very first step is education. I believe that the educated investor is an empowered investor, and I know your show provides a ton of insights and equips people with different pieces of the puzzle and knowledge that they can take away to be able to make their own investment decisions. But I'll definitely start with, hey, getting educated would be step number one. And then taking action, right? Going to meetups, signing up for these newsletters, connecting with sponsors, starting to view deals, and eventually making that first investment. Because you can you can read a lot and accumulate a ton of knowledge, but it won't be very meaningful if you don't turn it into action and make that first investment. It doesn't have to be big. Start small, but get started. And so when you combine that education with action, results will inevitably follow.
Yeah, we did an episode on that not too long ago on that kind of exact idea, right? Like you need to be educated, but ultimately it doesn't matter if you don't take actions. That's great. One thing I do want to touch on real quick. I know you do your own deals, bring those to investors, but you also have a passive investor sort of coaching program. Is that correct?
Yeah, so I partner with passive investors on where I connect them with investment opportunities. And yes, I also have a coaching program to help people who are new to multifamily learn how to effectively and efficiently analyze deals. I have that comes with a community and a self-paced course. And a lot of that was really inspired by the pain I was going through getting these calls from passive investors. And I figured, well, I can't clone myself, but if I can teach people how to fish, that's how I can have positive impact. And that's what inspired that, and have been very blessed to date to be able to help a lot of passive and active investors in the space through that program.
That's awesome. If I guess if folks want to learn more about that or more about you, what's going to be the best way for them to connect with you?
Yes, for underwriting help and support, I will go to masteringmultifamilyunderwriting.com. Otherwise, for passive investing insights and to connect with me, dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. And on social media, I tend to hang out mostly on LinkedIn, so that's another way to connect with me as well.
All right, what's your handle there?
It's my first and last name, Vessi Kapoulian.
Okay. Good deal. Adam, any other questions?
Nothing for me. I'm very glad we were able to have you on today.
Yeah, Vessi, this has been great. I think it's been really good, and really insightful for passive investors. So appreciate your perspective and bringing that lender perspective to things. I think it's really good.
Absolutely. I really enjoyed the conversation, and thanks for having me on.
All right. Thanks, Vessi. All right. Well, that was awesome, actually. That was a good conversation.
I thought she brought a lot of valuable insight. It's interesting to see how someone with a previous lending background analyzes deals, right? I mean, and Robert Helms always says you need a good team and then a good market and then a good property. Like that's the order. You could have the best property in the worst market with the worst team and you're getting nowhere. You could have the best property in the best market with a horrible team and you're getting nowhere. You could have a great team in a bad market with a bad property and get everywhere. So it was interesting to kind of hear her reiterate the same thing of how she analyzes people. I thought some of the stuff that she said actually sparked, and I didn't want to bring it up on the call, but she said she asked for previous update letters to see how sponsors are, sending updates when one goes bad and things like that. And that sparked when we said the other day about how, if someone wanted to sit in on our asset management calls, I'd be like, oh, I don't really care. And so it was kind of a similar thing, right? And anyway, I thought those were some interesting takeaways. Definitely, she seemed very robust in her underwriting. It is funny to hear that to a certain extent, because I think I'm coming to learn that there's kind of two schools of thought here. And there's the super detailed underwriting, and our offer price is $11,455,000, and I can't move $1,000 above that. And then we have a mentor and a guy that we're doing a deal with right now. We just on that LOI we talked about in the beginning of this episode. It's a lot. We wrote that LOI today, and I was like, "Does this seem good to you, Tim?" And he's like, "Yeah,
it feels right. Yeah,
it feels good, right?" And I mean,
he didn't ask to see the spreadsheet.
No, he doesn't. I'm sure he looked at it at one point, but yeah, I'm sure he didn't scroll down.
Yeah.
And it's and he is very successful, right?
Yeah. And I think you kind of have to be able to do both, right? Like you've got to have I think to your point, it's that seat knowledge that allows someone like him to be able to do that. But at the same time, for our passive investors looking at deals, you want someone that can play both sides, that you've got the seat time that you can kind of know just from your gut, this is going to be good, but then also do that detailed underwriting, because end of the day, someone's going to be doing it and it needs to be done, right? At the very least, the lender's going to do that. And then for your own just due diligence, getting further into the deal, you need to be able to sort of have that level of detail and specificity, especially for talking to investors. And I don't know that as a passive investor, I would feel comfortable investing with someone that didn't do that. I would definitely, the gut feel is nice, but you definitely also want to know, okay, there's been some serious, pencil put to paper here to.
Well, and I think that's the interesting, it's all timing, right? Because when you're at the and we're turning this into a whole episode here, but when you're at the LOI stage, right, you just need to get a number in front of people, and you don't need to burn 80 hours trying to underwrite a building.
Yeah, and that's exactly what I was going to say. I think a lot of this comes down to staging. You don't do that heavy work at the very beginning. You do it once you're further along.
I only write LOIs if I can walk every unit.
Yeah, exactly. Until I've seen the inside of every single unit. But no, I mean, I think that I would encourage everyone listening, if you're looking at passive deals, I would honestly go back and listen to Vessi's criteria for how she goes through and what she looks at. I mentioned it during the episode, but I thought calling out, operating reserves, right? Like, I've never seen a broker that includes operating reserves on their OM, right? Like or deposit to replacement reserves or anything like that. But that's a very, very critical part. And if the sponsor's not accounting for that, I think that opens up a significant level of risk to you as a passive investor. The other, I guess, the only other thing I would say, I think it resonated. This is probably where something resonated with my background versus yours, Adam. Is she talked about following the standard path, climbing the corporate ladder. And then being exposed to layoffs, right? And like that's something I've certainly seen. I've worked for large companies. I've seen that firsthand. The talks of restructuring.
During COVID, I was fired for not being vaccinated, right? And that was
exactly.
I was able to say like, yeah, kick rocks. I don't care. I've got plenty of passive income.
And that, like, laying that foundation provides such an additional layer of security for times like that, to where if you start hearing talks of, is our division going to get restructured? What's going to happen here? Am I going to get moved around? What might happen? Am I going to like my new boss? Yeah, you might still have some of those concerns, but end of the day, they're just not as severe because okay, well, whatever happens, we've got this base of passive income.
And I've had that work out of my benefit to where I'm almost like the last man hanging on like a dead company.
Yeah.
Because it's like, everyone's like, I got to jump ship. I need security or whatever. And I'm like, they fire me tomorrow. But this job's easy. I'll stay.
The last point I'll make, she talked about climbing the corporate ladder, and it made me think of something that I think I first heard Russ Gray talk about, was like, if you're climbing the corporate ladder, that's fine. But what's at the top of that ladder? Like, are you going to get to the top of the ladder, the top of that building, and realize, crap, this was not somewhere I wanted to be?
I think that's Robert Helms in goal setting. And he says, you spend your whole life climbing a mountain, and you don't want to climb the mountain just to realize, I was supposed to be on that mountain. That's the mountain I wanted to climb. And now I got to go down the valley and back up the other mountain. And there's a hill in the way, and there's a river, and I don't know how to have a bridge. And
Vessi mentioned this, but I think she realized that early on, but wish she had realized it sooner. And I can certainly say the same thing for myself, but it's better to realize it. Today is better than tomorrow, right? I mean, yesterday would be better than today, but make that realization and then make whatever changes you need to make to kind of reorder your life or whatever you need to do if you realize you're not on the right path. So this is a great episode. Thought there's a lot of good insights there. I don't know. Anything else you want to call out before we get on out of here?
Nothing else for me.
All right. Well, with that, we'll mosey on. Everybody, we appreciate you listening. Thanks so much. We'll see you on the next one. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.